So the next one we want to look at is the gross profit ratio. Now we're into our grouping, our profitability group here, okay? So the next thing we want to look at is that gross profit ratio. And this is going to indicate for each dollar of COGS that you have, what is our dollar of sales above that. So essentially, if it costs us a dollar to make something or to sell something, what is our profit on that? If we sell it for $1.55, then our profit would be 55 cents. What we will typically do here at a high level is just look at our cost of goods sold at a high level, right? From that control account, that cost of goods account, from that net sales account. What you can do with this, though, is you can drill down to specific costs. You can drill down to specific inventory and see, okay, which inventory are we making the most profit of? Maybe we want to invest some more resources into selling more of that or stocking more of that so that we sell more. Maybe we want to stop selling this particular item because our profit margin is so low. Or if you ever watch any videos about like Costco is a good example. You know, they sell hot dogs for like 50 cents, right? They don't make any money off of that. They lose money. That's got a very low profit ratio. It's got a negative profit ratio, right? But it gets people in the door. And once they're in the door, they are buying those higher dollar items. This is the kind of decisions that they are making when they look at these ratios, right? So what you're going to do is you're going to take your net sales. You're going to subtract your cost of goods sold from that, okay? And then you're going to divide by your net sales. Notice, this is net sales. This is not gross sales. This is net sales. Net sales being your gross sales less any sales returns, allowances, or discounts, okay? So please, please, please don't get that confused on your exam or on the homework. Make sure you are always using net sales and not gross sales. Okay, otherwise you will get it wrong. I can guarantee you what will happen is that one of the answers that you get on A through D will be gross sales less cost of goods sold divided by gross sales. And you will think you've got it right and you will be super pumped about it, but you'll have gotten it wrong because you forgot to take out the allowance or the discount. Okay, so please, please, please be cautious. Always make sure you're using net sales here. Okay. One interesting thing to note about the gross profit ratio is that you will see this decline as competition increases. Okay. The reason for this is because as more competitors enter the market, you guys are having to kind of battle back and forth on your pricing. So somebody's going to lower their price, and then somebody will lower their price, and then somebody will lower their price. So eventually it's where maybe you guys are just breaking even, or maybe even like we talked about, you're losing a little bit of money, but you're getting them in the store to buy other things, okay? But you see that decline in gross profit simply because you are having to reduce your sales prices on occasion to remain competitive in the market, okay? So the next one we'll talk about is profit margin, and this is just a measurement. It measures income earned for each dollar of sales. So for every dollar in sales that I make, what do I actually get in net income? Now remember, the difference between net sales and income is net sales is everything less your allowances and discounts. Net income is your net sales less all of your expenses, operating expenses, non-operating expenses, income tax, all of that stuff, right? So what this number here is telling us is that for every dollar I make in sales, I get a 6% increase to my net income. Okay. So pretty useful. So this is a pretty useful metric when you want to know how much income you're actually generating. This could help you kind of project your tax. It could help you do some tax planning. It could help you maybe decide on the dividends that you're going to pay out, that kind of thing. So very important metric. The next one is asset turnovers. So asset turnover just measures your sales volume in relation to the investment in assets, right? So how often are you turning over assets, basically? So for every dollar that you invest in assets, how many dollars are you generating in revenue? Okay, so for instance, here we can see that VF is generating $1 for every $1 in revenue for every $1 that they invest in assets. Well, what if Nike's got an asset ratio of 1.4? What does that tell us about the efficiencies of the two companies? Well, it really tells us pretty quickly that Nike is more efficient at managing their assets than VF is. And again, this leads to more questions about, well, what kind of assets do they have? What are they classifying as assets? Can we go in the 10Ks, look in their notes and their disclosures? Can we look in their balance sheet and see how they're classifying assets, how they're depreciating assets, all of that good stuff. So the next one's receivables turnover. Receivables is one of my favorite metrics to look at. I love allowances. I love bad debt. I love AR. It's one of my favorite metrics to look at and measure, and probably from my time in healthcare, because cash and AR were the two very big, most important metrics that we've looked at from a revenue perspective, right? So the receivables turnover ratio tells us how many times do we collect our receivables balances during the year, okay? So the higher the receivables turnover ratio in this case, it just means they're turning their receivables into cash more quickly. So let's just recall, what is a receivable? Well, a receivable is a customer's promise to pay us cash in the future. And when we collect on that receivable, when we turn that receivable over, it means that we have turned it into cash. And we want to turn it into cash because once we turn it into cash, we can then use it in our operations to invest in new resources to help us generate more revenue in the future. It's just a positive thing. So the higher this is, the better off you are. Now, if you have a lower ratio, it might tell us that maybe you're having some trouble collecting from customers, which could tell us that maybe you're extending credit to the wrong type of customer. And when we see this happen a lot is when, let's say, a manager's bonus for the year or for the quarter is tied to a sales figure, okay? What they may do is extend credit to people that don't really deserve that credit, that really we know aren't going to pay us back, but it boosts that sales number, right? It boosts the sales figure, it boosts the revenue figure. What it doesn't do is boost your cash figure. And in the end, if you recall from like chapter 5, what do we do with receivables? Well, we have that bad debt figure, right? We know that portions of this receivable are just not going to be collectible at all. So we have that allowance for uncollectible accounts. We have that bad debt expense, okay? So a lower ratio probably tells you that you need to go back and evaluate your credit policies, evaluate your procedures on how you try to collect your receivables. The next one really is one of my favorites. It is average collection period. This is what we just refer to as days in AR, okay? How many days does your AR just sit there before it's collected? How long does it take you to convert your AR to cash, okay? The shorter the collection period, it just tells us you're more efficiently and more quickly collecting cash. And what do we say? The quicker you collect cash, the quicker you can use that asset to turn into other assets to help you generate more revenue for the business. It's a good thing, right? Typically what we saw in the healthcare industry, just speaking from experience, our business cycle, our operating cycle was 60 days. We wanted to see our days in AR at or below 60 days. And that told us we are doing a good job efficiently collecting the money that's owed to us. However, that was not usually the case. Very, very, very seldomly did any of our service areas actually hit that 60-day mark. Bigger service areas were fairly close, usually within 10 days. Smaller service areas that didn't have the kind of resources that these larger ones did. So let's say Springfield versus like Lebanon here in Missouri, right? Springfield, much bigger place. The hospital here is much bigger. They have more resources to invest in collecting those receivables. Lebanon, much smaller place, probably, 1/25th the size of Springfield. They have a harder time collecting their AR, so they had higher days in AR. What it might tell you is a couple of things. First of all, you need to look at the size, right? You need to look at the economies of scale here. if Nike's is significantly lower than VF, it could just very well be that Nike has more resources that they can spend on collecting AR. Okay. It may also mean that VF just doesn't extend credit all that often, and so they don't put a lot of effort into collecting that credit, or they've got more lax credit policies. Another thing it might tell you is that you need to examine your effectiveness of your credit policies. Examine who you are lending to, who you're extending credit to, how you were going about collecting those receivables. Okay, so I will bring one thing to your attention for testing purposes. These two are they lend themselves very well to backing into numbers, right? Plugging and chugging. They may say, hey, your average days in AR is 46.8 days. Your net credit sales were this. What's your average AR, right? So you'd have to back into that. This is what I always call that plug and chug figure, right? Plug in the numbers you know, chug for the one you don't. So just be aware of that. I do like those kinds of questions where you have to really understand the concept and back into a number. Okay. Let's see this video. Yeah, I think this video has gone on quite long enough. I'll cut it here. We'll come back. We'll talk about inventory turnover ratio and a few more ratios, and we will be pretty close to the end. We may even be able to finish this up in the next video. So, as always, any questions or concerns, please contact me, and I will be happy to help you through it.